Hey everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about another strategy that we use at the poor man's covered put. Now, if you missed yesterday's segment, which was the poor man's covered call, you can check that out by clicking Find Shows at the top and scrolling down to Mike and his whiteboard, and it should be the last one listed. So the poor man's covered call, which we discussed yesterday, is a synthetic strategy that essentially replicates a covered call, which is a bullish assumption. And today we're going to talk about a poor man's covered put, which replicates covered put or a covered short stock with a short put sold against it, which is a bearish assumption. So two different assumptions, a little bit different intricacies with the different strategies. So let's get into it and we'll figure out why. So when we're talking about a poor man's covered put, we're essentially purchasing a long in the money put with a longer days till expiration and selling a short out of the money put against that with a shorter days till expiration. So when we're talking about a covered put, we basically have short shares of stock. So if we are selling one contract against it, we have 100 shares of short stock. And basically what this does is creates a position that is bearish. So instead of just shorting the stock outright, I'm essentially selling the put, which is capping my profitability to the downside, but it's also reducing my cost basis overall, which is going to increase my probability of success. So one thing to point out with a covered put compared to a covered call is that a covered put has essentially unlimited risk to the upside. So with a covered call, we talked about yesterday how it's essentially buying 100 shares and selling a call against it, where we know that shares cannot go below zero. So our risk is essentially defined in that strategy. However, with a covered put, since we're short shares of stock and stock has no limit to the upside, this is more of an undefined risk strategy. So when we compare a covered put to a poor man's covered put, what we do is we take that undefined risk and we transfer it into defined risk. So instead of shorting shares of stock, we are purchasing a longer dated put. So here we're looking at a December put, and let's say we're selling a October put against it. So what this does is gives us that replication or synthetic strategy that's going to act a lot like a covered put position would be. But number one, it's going to be defined risk, and it's going to use a lower buying power reduction, which is going to benefit us in some ways. So let's go to the next slide and we'll break down a poor man's covered put and how we would set this up. So we've got the October expiration. Let's say the stock price is right at 90. So what I would do is for this position, I would sell that October put out of the money. And again, with a put contract, a put is out of the money when it's below the stock price. And if we just review what a put contract is, a put contract is the right to sell 100 shares of stock at a certain strike price. So that's going to be out of the money below the stock price, because if I'm the purchaser of the put, I'm not going to exercise that when I could sell my shares at 90. Although I might own this put at 85, it's going to be out of the money. There's no real intrinsic value because it's below the stock price, and I can sell those shares at a higher price. So if I'm selling the right for someone else to sell me their shares, then it's going to be out of the money if it's below the stock price, which is where I'd like that to stay with a short put alone. However, since I'm buying a long put in December, now it turns into a bearish strategy, and I'm going to be purchasing this for a debit. So let's walk through these numbers here. So let's say that we are looking at purchasing the December option with the 100 strike. And if the stock price is at 90, I know right off the bat that my intrinsic value is $10. So I've got the green number here, which is $10. So there's $1,000 of intrinsic value. So basically what this means is that if the stock price were to stay here at expiration, this put would be worth $1,000 or $10 in options terms. However, since nothing really trades for just intrinsic value when we're far away from expiration, because we have to be paying some sort of premium to have the right to own that contract for a certain amount of time and allow us to realize some certain volatility in that expiration, there's going to be a buffer of premium. So this is what is going to be the extrinsic value in this option. So we know that there's $10 of intrinsic value, which is really just the difference between the stock price and the strike price. And if this option's trading for $13 and I know that there's $10 of intrinsic value, I can quickly subtract that and come to the extrinsic value of $3. Now, just like we talked about yesterday, what we like to do at tastytrade here is basically if we're going to deploy a strategy like this, we want to make sure that we know this number, this $3 value, so that we can cover that in the short option that we sell against it. Because at the end of the day, what we don't want to happen is for us to have a negative theta position where we're losing money if the stock price stays right here and nothing really goes our way. We want to be in a position where we can reduce our cost basis enough to the point where even if it doesn't move anywhere, I can still purchase this for $9.50, and at expiration, if this expires worthless, this put over here in October, and I'm able to sell this December put back for $10, I can make that 50-cent profit. So that's the kind of position we want to put ourselves in, which is why it's very important to calculate this number and then look for an option in a near-term expiration. So I chose October here, and I made sure that I'm covering at least $3, which you can see here with that $3.50. So I'm basically covering the extrinsic value that I might lose in this position in December. Now, I also had an inquiry today on support where we talked about yesterday how to find this number easily. So another thing you can do is take that 100 strike, and if we're looking at a put, what I can do is look on the opposite side, on the call side for December. So generally, if I've got an in-the-money put, if I'm looking at a 100 strike for a call, it's going to be out of the money for the call side, and it should be trading right around that same amount, $3 give or take. So what I could quickly do if I didn't want to do this intrinsic value math is just look at the calls if I'm looking at purchasing a put, look at the call side for the 100 strike, and that value should be pretty close to the $3 there. And for yesterday, if I was purchasing a call in that example, I would look in that longer dated expiration, look to the put side since I'm looking at the opposite side, and determine that value there. So again, the takeaway for this slide is just that we want to make sure that we know our extrinsic value and we do our best to cover that extrinsic value with the near-term option that we sell against it. So we talked about poor man's covered puts today. We talked about poor man's covered calls yesterday. So let's compare the two in the next slide, and we'll talk about some differences and similarities. So with a poor man's covered put, I have a bearish assumption. So when I'm doing this, I essentially want the underlying to go down. It is going to give me an opportunity to pretty much pay a debit and define my risk, and I would reap the rewards if that underlying actually does go down. For a poor man's covered call, however, the assumption is the opposite. So I'm purchasing a longer dated call and selling a call against it, so I want that underlying to go up because with the call contract, it gives me the right to buy 100 shares of stock as opposed to with the put contract, which gives me the right to sell 100 shares of stock. So that difference there is why this assumption is different. However, both of these are defined risk. So in both of these scenarios, I'm purchasing this strategy for a debit. So I'm going to be purchasing that longer dated option and then selling a shorter dated option against it to reduce my cost basis, which is what we're all about. For both of these strategies, the return on capital is going to be higher than their counterpart. So when we're talking about a poor man's covered put, the return on capital is generally going to be higher than if I were to just trade the original strategy, which is the covered put. And that's because I'm essentially defining my risk. I'm trading this for a certain amount of time as opposed to just selling shares of stock outright, which has unlimited amount of time, and it's going to use usually a higher buying power reduction. Same goes for a poor man's covered call. Now, like we talked about yesterday, the probability of profit, it's hard to determine because of that diagonal spread factor. So since we have one option that's in one expiration and another option that's in another expiration, it's hard to determine the probability of profit once one expires because let's say for the example today with the poor man's covered call, if that October option expires worthless, regardless of what happens with the other option in December, it's hard to determine what the volatility will be of this December option. So for that reason, it's hard to determine that probability of profit because the volatility of that longer dated option is greatly going to be affected by the option's price because option prices do drive implied volatility. So whatever that option price is going to be at, we'll see a reflection in the implied volatility, but we can never really know that value ahead of time, which is why it's implied. And last but not least, we've got the replicas. So with a poor man covered put, we're just replicating a covered put scenario, and with a poor man's covered call, we are replicating a covered call scenario. So let's get to some takeaways for today's strategy, which is the poor man's covered put. So, poor man's covered put replicates covered put position, and that is bearish. So, if I think an underlying is going to go down, then maybe this would be a strategy for me to deploy. And let's say I wasn't comfortable with selling 100 shares of stock or however many shares of stock and holding that undefined risk. Maybe this defined risk synthetic version would be something better for me. Also, poor man covered put is defined risk, so this is something that is great for me personally in my IRA account and margin account also. When I'm dealing with something with a smaller amount of capital, I'm going to be looking to define my risk and lower my buying power reduction, which is exactly what I can do with the poor man's covered put as opposed to a regular covered put position. So a poor man's covered put does yield a higher return on capital than the covered put, just like the poor man's covered call, and that's because it's got a lower buying power reduction. So when we're talking about return on capital, again, we're just taking the max profit on the position and we're dividing that number by the amount of capital that's used. So if I don't have to sell those shares outright and I can use a replica in the terms of a long put in December, that's going to cost me a lot less money. Although I am defining my expiration, it's going to give me a higher return on capital simply because I don't have to put as much money up to place the trade. And last but not least, poor man's covered put and poor man's covered calls do have less flexibility, in my opinion, than a covered call and covered put, and that's because we have those expirations. So with the long option in a poor man's covered put in December, and then also with the example in the poor man's covered call yesterday, when we define that expiration, so for the poor man's covered put, my expiration is December. So that underlying has to move in my direction by December, or else I'm going to probably see a loss on this trade unless I manage it in some certain way. However, if I have a covered put position, there's no expiration on those short shares. So I could theoretically, as long as my account can hold that value, I can short those shares for as long as I want, and I can pretty much wait until I'm correct on the position. So that's what differentiates the flexibility factor with a poor man's covered put and poor man's covered call. But obviously, as we've seen, there's definitely benefits to each of these strategies. So this has been an explanation of poor man's covered put. Hopefully you've enjoyed it. Thanks so much for tuning in. If you've got any feedback or questions, shoot it over to support@dough.com, or you can tweet us at doughtrading, at doughttradermike, or at. That's going to do it for me for this week, but on Tuesday we'll be back at it. So have a great weekend.